If you were born before 1971, I need you to stop scrolling right now. Because what I'm about to share with you in the next few minutes could put thousands of dollars back into your pocket before the end of this month. And I mean that literally. Not someday, not next tax season, before June 30th. I'm Linda, and I've spent the last several years helping retirees just like you cut through the noise, skip the confusing tax jargon, and actually keep more of the money you worked decades to earn. If this is your first time here, hit that subscribe button right now because every single week I bring you real, actionable information that your tax preparer probably never told you about. And today is one of those videos that people share with every retired person they know. Here's what's happening right now that most seniors have absolutely no idea about. There are 5 specific IRS and Social Security forms sitting on government websites, completely free, available to anyone born before 1971, and they are being ignored by millions of people every single year. Not because people are careless, not because they don't care about money, but because nobody ever told them these forms exist. The IRS doesn't send you a reminder. Your tax preparer doesn't automatically include them. And the longer you wait, the more money slips through your fingers. I'm going to walk you through all 5 today, one at a time in plain English. No confusing terms, no fine print runaround. Just the real information you need to take action before that June 30th window closes. Before I give you form number 1, I need to clear something up because this is the misunderstanding that causes people to click away and miss out on thousands of dollars. Some people hear IRS forms and assume this only applies to seniors who are struggling financially. Others hear it and think it's some complicated strategy designed for wealthy retirees with investment portfolios and financial advisors on speed dial. Both of those assumptions are wrong. These 5 forms apply to every American senior born before 1971. Whether your entire income is a Social Security check, whether you have a pension and savings and a home that's doubled in value, or whether you're somewhere in the middle, there is real money inside these forms with your name on it. The only question is whether you're going to claim it before the deadline. Now stay with me all the way to form number 5 because I promised you at the start that I'd share a real story about a couple in Arizona who saved over $5,000 in a single year, starting the month after they filed one form. I'll walk you through exactly what they did and how it worked. But first, let me give you form number 1 because this is the fastest one to act on and it starts putting money back in your account the very next month. Form W4P. You can find it for free on irs.gov right now. This form controls how much federal income tax is withheld from your pension, annuity, or IRA distributions every single month. And here's the problem that is quietly costing retirees hundreds of dollars a month without them even realizing it. When pension programs and IRA custodians set up your distributions, they almost always default to a withholding rate that is too high. They assume you have more taxable income than you actually do, so every month they hold back more than you actually owe. You get a refund in April, you feel good about it, and life goes on. But here is what that refund is actually costing you. That money was yours all year long. You just gave the federal government an interest-free loan for 12 months. You earned nothing on that money. The government held it, did whatever they wanted with it, and handed it back to you in the spring, like they were doing you a favor. Let me make this concrete for you. Picture a retiree named Harold. He's 66 years old, living in Georgia, collecting a $38 annual pension. His custodian is withholding 10% automatically, which sounds reasonable on the surface. That's $3,800 a year being held back from him. But because Harold is 65 or older, with the additional standard deduction available to seniors, his actual federal tax liability on that pension is closer to $1,400, not $3,800. That's a $2,400 gap. $2,400 he's been lending to the government every year for free. That's $200 a month that should be sitting in Harold's bank account right now. Form W-4P is how he takes it back. He downloads it from irs.gov, fills out the withholding worksheet, submits it to his pension administrator or IRA custodian, and his withholding adjusts the very next month. Not next year, the next month. That is how fast this works once the form is filed. Quick question before I move to Form 2. Are you currently having federal tax withheld from your pension or IRA distributions? Drop a yes or no in the comments right now. I'm putting together a follow-up video specifically about how to calculate the right withholding amount for different retirement income situations, and your answer tells me exactly how many of you need that information right away. Form number 2 is for anyone collecting Social Security, and this one deals with a problem that blindsides retirees every April in a way that feels completely unfair. Here's something most people don't know. Social Security payments arrive with zero federal tax withheld by default. Not 5%, not 10%, zero. For some seniors, that's perfectly fine, because their overall income is low enough that their Social Security isn't taxable at all. But for millions of seniors born before 1971, a portion of that Social Security benefit is taxable. And the zero withholding means they owe money at tax time. Sometimes a lot. And sometimes they get hit with an underpayment penalty on top of the tax bill, which adds insult to injury in the worst possible way. Form W-4V is how you fix that. It lets you choose your withholding rate directly from Social Security. You have 4 options: 7%, 10%, 12%, or 22%. You pick the rate that most closely matches what you actually owe based on your income picture. And here's the thing I want you to understand about this form, because it cuts both ways. Some seniors are under-withheld and end up owing money they didn't plan for. But just as many seniors are over-withheld. They set up 22% years ago when their income was higher, and now they're overpaying by hundreds of dollars a month when their actual tax rate is much lower. Meet Dorothy. She's 70, married, and she and her husband both collect Social Security. Their combined benefit is about $34,000 a year. Her husband set that 22% withholding years ago when they were earning more. Now, based on their current deductions and income, their actual effective tax rate on that Social Security income is closer to 9%. They're overpaying by roughly $2,200 a year in withholding alone. That's more than $180 every single month that should be in their checking account paying for groceries and prescriptions and gas instead of sitting at the government's door. One new Form W-4V sent to the Social Security Administration adjusts that going forward. You can submit it online through your My Social Security account at ssa.gov. Mail it to your local Social Security office, or bring it in person. Form number 3 is the one I get the most questions about. And honestly, it surprises me every time I hear how many seniors are still not using it. This form was literally created for people in your age group by the IRS. It is called Form 1040-SR, and it is the official senior tax return. And yet, millions of Americans born before 1961 still file the regular Form 1040 every year without knowing this version exists. Now, you might be thinking the only difference is bigger print. And yes, the print is larger, which is genuinely useful, but that is not why this form matters. What matters is what's built into the structure of the form itself. Form 1040-SR has a dedicated section for calculating the additional standard deduction for seniors 65 and older. It has a cleaner, more intuitive layout for reporting Social Security income and pension distributions, which happen to be the 2 most common income sources for people watching this video. And it includes the built-in sections for the senior bonus deduction that many tax software programs and many tax preparers do not flag automatically when they're working off the regular 1040. You can technically claim everything on the standard form, but the 1040-SR is designed so that the deductions and income categories that matter most to you are front and center, not buried 3 worksheets deep in paperwork that a 35-year-old filer would never need to navigate. If you use a CPA or tax preparer, here's exactly what I want you to do before you sign anything this year. Ask them one specific question. Are you filing my return on Form 1040-SR? If the answer is no, ask why not. If they can't give you a clear reason, that's a conversation worth finishing before you sign. If you file your own taxes using software, look for the option to switch to the 1040-SR before you submit. Most major tax software supports it. I want to pause here for just a second and make sure you know this video is for educational purposes only and is not personalized tax or legal advice. Tax laws are complex. Everybody's situation is different, and I always encourage you to consult a licensed CPA or enrolled agent before taking action on your specific circumstances. What I'm sharing today is real information from IRS.gov and SSA.gov, but how it applies to your situation is something only a qualified professional can confirm for you personally. Now, form number 4. This is the one that sends retirees into complete shock when they realize what's been happening to their money for years. This form is about something called IRA basis, and not knowing it exists can cost you tens of thousands of dollars over the course of your retirement. Here's how this works. When most people contribute to a traditional IRA, those contributions are tax deductible. You put money in, it lowers your taxable income for that year, and you pay the taxes when you withdraw it later. That's the standard deal everyone knows. But some people, particularly those whose income in certain years was above the deductibility limits, made what are called non-deductible IRA contributions. That means they put after-tax money in, money they had already paid income taxes on. The problem is this. If nobody tracked that after-tax amount, which is called your IRA basis, then when you start taking distributions in retirement, the IRS has no record that any of that money was already taxed, so they tax it again. You pay income tax on the same dollar twice, once when you earned it and once when you take it out decades later. And you may have absolutely no idea that's happening to you right now. Here's a real example. Let's call him Robert. Over the course of his working years, Robert made $45,000 in non-deductible IRA contributions. He never consistently filed the form that tracks this, and neither did the accountants he used during those years. Now he's 68, taking required minimum distributions. And because there's no documented IRA basis on file with the IRS, his custodian reports every dollar coming out as fully taxable income. At a 22% federal tax rate, that's nearly $10,000 in taxes he should never have owed. Gone. Permanently, unless he or his current CPA takes steps to address it. Form 8606 is how you document your IRA basis. You file it with your annual tax return for any year you make a non-deductible IRA contribution. And here's what most people don't know. If you've made past non-deductible contributions without filing Form 8606, you can work with a CPA to file amended returns and establish your basis going back to those years. This form is also critically important if you've ever done or plan to do a backdoor Roth conversion. Without Form 8606 on file, the IRS has no record that the original contribution was non-deductible, and the conversion looks fully taxable on paper when it shouldn't be. If you've contributed to a traditional IRA at any point during your working years and you're not certain whether all of those contributions were deductible, this is a conversation worth having with your CPA as soon as possible, before June 30th. Now we have reached form number 5. I told you at the very beginning of this video that the last one was the most powerful on the list. I meant that. This is the form that most seniors have truly never heard of, and it has the highest dollar impact per month of anything I've shared with you today. To understand why it matters so much, you need to understand something called IRMAA first. IRMAA stands for Income-Related Monthly Adjustment Amount. It's a Medicare surcharge, meaning an extra charge added on top of your regular Medicare Part B premium that hits beneficiaries whose income exceeds certain thresholds. Here's how it works in 2026. The standard Part B premium is $185 per month for most beneficiaries. But if your income from 2 years ago exceeded certain levels, Medicare is charging you significantly more than that right now. For single filers, IRMAA surcharges begin when modified adjusted gross income crosses a set threshold, and the additional charges can range from $74 up to $443 per month per person, depending on the income tier. For married couples, both spouses pay separately, which means the combined annual impact can be enormous. And here is the trap that catches retirees specifically. Medicare doesn't look at your income from this year. It looks at your income from 2 years ago. So if you retired in 2024 and your income that year was elevated because you worked for the first 6 or 8 months, or because you received a large pension payout or sold a property, Medicare used that elevated 2024 income to set your 2026 premiums. Even though your income dropped dramatically when you retired, even though you are now living on Social Security and a modest pension that's a fraction of what you made in 2024, you are still being charged an IRMAA surcharge based on income you no longer have and will never have again. That is not fair. And the Social Security Administration built a specific correction mechanism directly into the system for exactly this situation. That correction is Form SSA 44. It's a life-changing event appeal, and it allows you to tell Social Security to use your current income when calculating your premium, rather than that 2-year-old figure that no longer reflects your life. There are 8 qualifying life-changing events that make you eligible to file: marriage, divorce or annulment, death of your spouse, work stoppage, meaning you retired, reduction in work hours, loss of income-producing property, loss of pension income, and receipt of a one-time employer settlement that temporarily inflated your income in a prior year. The most common one for the people watching this video is number 4. You retired. That alone qualifies. Now here's the real story I promised you. Frank and Carol, both 67, living in Arizona. Frank retired from his engineering career in June of 2024. Carol retired from her position with the school district in July of 2024. For the months they worked before they retired, their income was elevated. Frank's modified adjusted gross income for 2024 came in at $138,000. Carol's came in at $122,000. Because Medicare looks back 2 years, both of them were hit with IRMAA surcharges on their 2026 premiums. Frank's surcharge added $259.20 per month to his Part B premium. Carol's surcharge added $74 per month to hers. Together, they were paying over $330 extra every single month on top of their standard premiums, based on income they hadn't earned in nearly 2 years and would never earn again. Their actual combined income in 2026 was $52,000 from Social Security for both of them and a small pension from Carol's district. Frank filed Form SSA 44, checked the work stoppage box, and submitted documentation showing his projected current income. Carol filed the same form for her own Medicare account. The Social Security Administration reviewed both appeals. Frank's premium dropped back to the standard rate. Carol's dropped back to the standard rate. Their combined monthly savings came to more than $330 per month. Annualized, that's nearly $4,000 in premium savings. And because they filed early in the calendar year, they recovered surcharges that had already been paid going back to January. Total savings for the couple exceeded $5,000 for the year. One form each, free from ssa.gov, about 20 minutes to complete. $5,000 recovered. That is not a small thing. You can find Form SSA 44 at ssa.gov right now. You can submit it online through your My Social Security account, mail it to your local Social Security office, or bring it in person. The correction, once approved, typically takes effect within 1 to 2 billing cycles. And unlike a lot of government processes, you do not have to wait for open enrollment to file this. You can submit it at any time during the year. Most seniors never file it because most seniors have never heard of it, and now you have. Let me bring all 5 of these together before I let you go, because the priority order matters, and I want to make it simple for you. If you are currently paying an IRMAA surcharge, start with Form SSA 44 at ssa.gov. The monthly dollar impact is the highest on this list, and the correction takes effect the fastest. If you're receiving pension or IRA distributions and your withholding seems higher than what you actually owe, Form W4P at irs.gov is your second step. If you're collecting Social Security and you're not sure your withholding rate is right for your current income level, Form W4V at ssa.gov is step 3. Then confirm with your tax preparer that they're filing your return on Form 1040-SR. And finally, if there's any history of non-deductible IRA contributions in your past, bring up Form 8606 with your CPA in that same conversation. Here is what I want to leave you with, and I want you to really hear this part. Every single one of these forms already exists. The IRS and the Social Security Administration already accept them. Your savings are already legally yours. They're sitting there right now. The government is not going to call you to remind you to file them. No one is going to send you a letter saying, "Hey, you've been overpaying and here's your money back." The system is set up so the money stays exactly where it is unless you stand up and claim it. These 5 forms are how you do that. You worked for decades. You paid into this system your entire life. You earned every cent that these forms can put back in your pocket, and you deserve to keep it. Do me one favor before you close this video. Think of one person you know who was born before 1971. A parent, a neighbor, a sibling, a close friend who just retired last year. Send them this video right now. One share from you could be worth thousands of dollars to someone you care about, and that is not an exaggeration. Drop a comment below and tell me which one of these 5 forms was completely new to you today. Or if you've already used one of them and it worked for you, tell me what it saved you. I read every single comment on this channel, and your experience helps the next person who watches this video find the answers they need. This is Retires with Linda, and I'll see you in the next one.